we're also seeing monetary base actually surging to similar ways that we saw back in the QE1, QE2, QE3, and even the COVID stimulus period. And so this is as good as it gets to me when it comes to an environment to invest in hard assets.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials while supplies last. First, we feature 2023 1-ounce Silver Krugerrands at $3.10 over spot. We also have backdated 1/10-ounce gold Canadian maples at $35 over melt with a minimum order of 4. And finally, we're offering our choice 1-ounce Palladium bars at just $119 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Tavi Costa from Crescat Capital. Tavi, thank you so much for joining us today.
Thanks for having me. Looking forward to this.
Well, it's great to have you today. We just finished the Easter weekend where we had the highest quarterly close ever for gold. Your perspective on this, and where does it lead gold going from here?
Well, it's the most important thing going on in markets, in my opinion, because if it is indeed signaling that we're entering a bull market, usually bull markets in gold are secular at their nature. And so we're likely to be entering one here. And if that's the case, there's a lot of things that are very mispriced. And there's a lot of opportunities on the upside of things that need to be re-rated much higher in valuations. And you can say that that's the miners, you can say that that's silver, that's platinum, that's other precious metals, that's copper. I've never seen a gold market that actually, it starts a secular move that doesn't also trigger other commodities to do the same. And so there will be a lot of things that will be linked to that move itself. And it's important to note that we are yet to see Western societies, especially general investors from Western societies, to start really purchasing the metal and accumulating to the same degree that we're seeing with other Eastern societies, especially central banks in other Eastern parts of the world. And therefore, why we're seeing this breakout in gold that is not really intended with a large increase of flows into the GLD. And also, you can tell that this is most likely driven by purchases of central banks because the miners are not moving yet. And miners are not purchased by central banks usually, and therefore they are not receiving this optimistic side of the flows. But they will likely receive that from the general market as we see not only the improvement of the economics of their own projects, which we're seeing. I usually talk about the second wave of inflation and the likelihood of the reacceleration of consumer prices. But notice that the miners themselves are also starting to see a very good increase of their own free cash flow growth. And so if that's the case, the price of those shares are yet to also follow the upside of the metal as well. So there's a lot of very positive things happening across the space, and I can't recall a better time to be a precious metals and commodity investor than today.
Now, you mentioned in your recent insights on Crescat Capital that there are a lot of factors that are pointing to a second wave of inflation. Can you go over some of these? And it seems like one of them is that gold is already anticipating it, which it typically does. We saw gold anticipate the inflation, the last wave of inflation, and it seems like gold is anticipating something coming in the near future.
That's right. I think that's certainly the case. But there are other things that are very important. Agricultural commodities, for instance, surging in prices recently and making new highs and surpassing the levels that we saw during the Russian invasion is certainly a very important one because it's likely to drive food prices that are still diverging from agricultural commodity prices. And that's going to be an important inflationary part of the problem. The second thing that is likely to happen here is also what's going on with energy prices. I've been noticing how oil prices have been on the upper trajectory recently, and they're actually breaking out today. And if you look at the share price of energy companies as a potential roadmap for this, you can notice that energy companies are actually trading higher than they were back in the Russian invasion period. And why do I keep mentioning the Russian invasion period? Because there's an old saying in markets that when something trades at a level and it declines substantially from those levels, it will ultimately at some point go back to those levels. And I think we're in the process of seeing that in a lot of commodities. And agricultural commodities are just leading the way to the upside along with gold, but other things are yet to follow. And so we're seeing energy prices now, oil trading above $85 a barrel. That is actually likely to gain momentum. And probably there's still a 50% implied appreciation to go back to those Russian invasion levels back in May or so of 2022. So there's a lot of potential there for growth in prices. Now, shipping prices are also experiencing a second wave of inflation. And the other thing that I notice that is really important, not only from a long-term basis, this is a long-term trend, but also that is having an impact in the short term as well, is what we're seeing with illegal immigrant surge in the US. And that is also likely to drive shelter prices a lot higher. There's other things that will be impacted by that, maybe crimes and other things that are likely to be also increasing as part of this trend. But I would say that the shelter cost pressure is one of the most important ones. It's the most important component of CPI, if you think about it. And a lot of people that are making the case for the deceleration of inflation moving forward are actually not in line with this. These changes in demographics in the U.S. Other things like monetary conditions are also really loose, and we're seeing the Fed now for the last few months change their tune to a more dovish stance in the midst of inflation expectations is starting to rise. And you can see that by looking at the 10-year break-evens or the 5-year break-evens, which is basically investors' expectation of where CPI will trend. And I know for most gold investors, they don't like to look at CPI, but it's a good way to think about how markets are repricing the probabilities for inflation expectations. And so that's, clearly we're seeing a Fed turning their focus towards labor markets, which are starting to deteriorate, and basically ignoring the fact that inflation is reaccelerating. And if they do cut rates, or if they do loosen even further monetary conditions, that should only add further fuel to the inflation fire of commodities in particular that are also looking more and more attractive from a trading perspective as well. And remember, this is a political Fed, in my opinion. This is a very political Fed because there's not enough reasons here to be moving away from the current policy that is in place. And the fact that they're changing their tune in such a substantial way is definitely very meaningful for markets. And it should only add fuel to the fire here of inflation. And I would add one more thing. What we were pointing out yesterday with the fact that monetary base in the U.S. is increased by about $50 billion or $53 billion in the last month. And that is an increase of almost $600 billion from last year. So remember, this is one of the most restrictive monetary policies we've seen. And on the back of that, supposedly, we're also seeing monetary base actually surging to similar ways that we saw back in the QE1, QE2, QE3, and even the COVID stimulus period. And so this is as good as it gets to me when it comes to an environment to invest in hard assets.
Now, I'd like to put up the monetary base chart that you've shared here. Do you anticipate even more quantitative easing, even more money creation from the Fed as the Fed starts cutting rates and easing again?
Well, we as investors need to think about if the Fed is doing this while it's fighting inflation, imagine what it would do during the situation of a recession or a contraction in the global economy. That is a really important question because I think everyone knows the answer for that. And if that is the case, that we're seeing today's monetary level of dilution at that degree, and some people technically will call this non-monetary dilution because monetary base is actually, there's two components of that. One is money in circulation, which if that's increasing, that is indeed supposedly an increase also of monetary dilution. And the second one is bank reserves. And this is almost entirely driven by the surge in bank reserves and because of the repo market and other banking facilities that we saw actually to help supplement the banking crisis that we had in March of 2023. And in my view, despite the fact that some technical people may say that this is not QE, and that is, technically, again, it is not QE. It is actually a very dilutive policy in terms of fiat currencies, and the fact that central banks are completely addicted to always resorting back to more liquidity in the system when anything breaks. And so the fact that we're seeing such a Fed that is committed to fighting inflation, and despite all that, we're seeing monetary base increasing, it is scary because I think some folks have been actually calling this, the speculation era of investors. And certainly that's the case. I mean, valuations are at all-time highs in a lot of assets, particularly technology and consumer discretionary. And at the same time, we have this, the cheapness, how undervalued hard assets are relative to financial assets. To me, that's the opportunity. When you talk about making big returns, to me, it's all about also knowing what is your risk when you're investing. And the fact that you can deploy capital into those industries that offer a much better, much more compelling value proposition to invest. And I'm referring to commodity companies, emerging markets that have resource-rich properties, and all sorts of investments that are linked to commodities and hard assets are, to me, much better way to invest. And so, we are likely, and remember, there's even other things we can look at. Money velocity has turned. Money velocity used to be the main reason why people believe that we are not in an inflation era. But now, after multiple quarters of an increasing money velocity, I think we can all assume that this is a different era than we've seen in the last 3-4 decades, with a declining trend of money velocity. And that just means that inflation is likely here to stay and will probably be higher than historical standards. And that, we have to think about how do we invest in those environments. And usually hard assets and commodities do very well.
Now, this chart here, we have the secular changes in U.S. equity markets. You created this chart that shows the S&P 500 rolling 10-year return. And this is really interesting, I thought, because most people are looking at the indices and saying, they're hitting all-time highs every day. But this chart shows the bubble pretty much topped back in 2021. It seems to show that really the market has kind of topped out a lot earlier than people would have expected. Can you expand on this? And what is this chart saying for the stock market going forward?
Well, it means that the periods of excessive returns in equity markets in the U.S. are probably at their end, not at the beginning. And so, that you can see that those are really big long-term trends that we have throughout history. And so what we had today in the last 10 years, 15 years was not unprecedented, in terms of the returns. We've seen this before, but we're probably at the we've seen actually the peak of this, and we're actually at the early innings of a deceleration of returns. And notice how we usually go to the negative camp during inflationary eras in this chart. And I think we're going to go there again. And that's usually linked to the fact that when inflation rises, it causes one thing: cost of capital to rise. And cost of capital, there's two components of that usually. That's the debt cost, which is caused by interest rates that we all know, that we all follow. And we know that the Fed the government in the U.S. is completely trapped, therefore causing this flood of issuances of treasuries that is pressuring yields higher. And the other side of this is the equity cost, which equity cost is essentially what investors expect in terms of returns, but also dividends. And we're starting to see an upward trend of dividends because yields are higher. And so when yields are higher in the debt market, it causes competition for equity markets, and equity markets are then forced to start doing shareholder-friendly policies in which we haven't seen for many years outside of buybacks. And so dividends are coming back. And you know that when you see airline businesses are starting to announce they're going to pay dividends, because airlines are one of the worst margins in terms of a business model that you can find. When you start seeing those companies actually announce that they're going to be paying dividends, is because, and even the gold miners are paying dividends, and all sorts of companies are very capital intensive industries that because of that intensity doesn't allow them to actually share their profits in a big way, as we see in other businesses like utilities and others. And so, those are all important trends that we're seeing. And in my opinion, it will actually cause the cost of capital to be higher for longer. And if that's the case, we're going to have to discount companies at a lower valuation. And as we see that happening, it will probably cause the deceleration of growth that is in line with that chart, and probably cause negative returns at some point as well.
Now, this chart here is the miners to gold ratio, and you've really talked about, and we've talked about this before, how miners and silver are lagging when it comes to the appreciation in the gold price, are lagging gold. Now, one of the main reasons is because central banks aren't buying the miners and they're not buying silver, right? Do you see a situation where miners and silver continue to lag for many more months here?
Look, I think there is always the potential for something like a few or maybe 6 months of underperformance. But ultimately, the markets are efficient enough when you see gold prices really surging to, 25, 26, 2,700. Obviously that changes the dynamic of owning a mining company, and changes the dynamic of even silver itself, because they're all linked historically. And as we've seen, usually beginning of gold markets they don't usually occur with the gold to silver ratio at historical low levels. They usually happen when you are at historical high levels. And so we're yet to see silver really lead the way to the upside. But there's always going to be those short timers, investors or so, that will be caught up in this narrative that this time is different. And because of markets being irrational for a couple months or maybe even 6 months perhaps, it may cause people to be spooked out of that trade. But it is, in my view, the cheapest metal on earth, silver itself. But also the miners will, in my view, look as asymmetric as they could be. And so that will be a very important trade for the next 5 to 10 years, as we see this confirmation that the gold trend is actually a long-term one. And, I wouldn't be waiting for this. I mean, this is the main reason why we've been building a portfolio on this for the last years. And you never know when things are going to turn. You can try to be as smart as you can, but nobody knows when things are going to turn. But when you have the underlying factors there, which we do today, and you have gold moving the way it's moving, it's time to focus on what's next. And not only gold is likely just at the beginning of that trend, but other things are starting to show signs that they're also about to move. And as we all know, gold and silver miners and silver and gold miners and so forth, they usually well known for having very explosive moves. And look, I go around the world to meet with investors and go to conferences and all sorts of things that are related to our industry. And I got to tell you, there's nothing more hated than gold miners. Not uranium miners, not silver miners, there's not copper miners. There is nothing more hated than gold miners. It's even worse than coal, the coal industry. And so to me, or the cannabis industry even. And so to me, most times the skepticism morphs into opportunity. And this is going to be the case, in my opinion, here again. So that's why I'm laser focused on this, because I think this is going to be the big winner.
Now, when it comes to gold in particular, it seems like there is a fundamental shift happening. You also have a chart on gold versus treasuries, and it really is ever since 2020, they really disconnected, where treasuries have fallen and gold has continued to rise. And we've had such a strong correlation between those in the past. What is your take on that, and what has changed, and why do you think it's going to continue going forward?
Well, the main reason for the continuation of that trend that is likely ahead is because central banks are being forced to improve the quality of their international reserves. And as you look at the amount of issuances relative to how much purchases of treasuries, because central banks are not selling treasuries yet. That's an important point that a lot of people miss. Foreign treasuries are declining, not on the back of central banks actually selling them yet. They're just not being buyers relative to how much it's being issued. Imagine if we do see central banks selling that. Wow, that could be another pressure on the downside for treasury returns. And so that's such an important point to point out. The other thing to point out as well has to do with how much gold central banks own relative to their own international reserves, which is now approaching 20%, but still 19%. And we're yet to see that actually move towards historical average, which used to be 40, 50%. And why are we going to see that is a big question. Well, because especially when interest rates start to rise, inflation starts to rise, all those things are linked. What causes is disruptions in the monetary system. And so you start to see big FX volatility, which creates the need for a lot of central banks to actually improve the quality of their reserves. And I think we're in the process of seeing central banks being forced to improve their international reserve quality. And so that is really the big driver of all this. And wait until the 60-40 portfolios go away and start actually being called something else, because they have to actually move away from owning 40% of treasuries and maybe actually or bond market or fixed income instruments, and actually start stepping into the gold space or the hard asset space. And so there's a lot of opportunities there. And that's why I like this market, is because when I think about a thesis, I think about the optionality of that to work. And I see a lot of optionality, a lot of different ways that these things could start happening and unfolding the way I think it will. And so that's why the excitement and conviction comes in.
Fantastic. Well, Tavi Costa, it'll be very interesting to continue to track this with you. We love having you on and sharing the charts you create. I think they're very illuminating for our viewers to really get a good grasp of what is going on here in the financial system and with precious metals. If our viewers are interested in learning more, they can go to crescat.net. I know you're also on YouTube, Twitter. Can you share with us what they'll find there?
Yeah, they'll find we just put out a recent research letter that is really focused on this infrastructure spending build that we're seeing relative to history, that I think is really important, that will be a big driver of commodities. But you can find those types of researches in not only on Twitter at Tavi Costa, but also in my our website, Crescat.net, in which there are plenty research pieces there as well to be found.
Any last thoughts you'd like to add for our viewers?
No, it's time to be laser focused on this opportunity and not be overthinking about the short-term moves of maybe gold starting to have a surge in prices and silver not, or I should say the miners not immediately moving along the way. All that is just short-termism, as I call. And I think that the big opportunity, the big trend is still way ahead of us. And I think that's what excites me for the near future.
Fantastic. Thank you so much, Tavi, and God bless.
Thank you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials while supplies last. First, we feature 2023 1-ounce Silver Krugerrands at $3.10 over spot. We also have backdated 1/10-ounce gold Canadian maples at $35 over melt with a minimum order of 4. And finally, we're offering our choice 1-ounce Palladium bars at just $119 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.